All right, let's dive right in, shall we? We're taking a deep look at CK Hutchison's 2023 annual report. And wow, you've really given us a lot to work with here. Reports, analyses, even your own notes. Looks like you're serious about understanding this company.
Well, it's not every day you get to dissect a company with operations in 50 countries and over 300,000 employees. CK Hutchison is a fascinating beast, to say the least. Not just big, but incredibly diverse.
That's what makes this deep dive so interesting. It's like we're getting a glimpse into multiple interconnected worlds.
Precisely.
Okay, so let's map out these worlds, as you put it. We've got their core segments: ports, retail, infrastructure, and telecommunications. Am I right in thinking you're looking for a holistic picture of their financial health, but also how each of these segments is contributing to that, right?
You hit the nail on the head. We want to know where the strengths are, where the challenges lie, and ultimately what it all means for CK Hutchison's future, especially from an investor's perspective.
Got it. So should we start with what might be their most recognizable business ports and related services? I see you've highlighted their global reach in your notes.
52 berths worldwide. That's a serious footprint. And in 2023 alone, they handled over 21 million TEUs. That's 20-foot equivalent units, the standard measure for those big cargo containers. Just to give you a sense of scale, if you lined up all those containers, you'd have a container ship stretching almost 200 miles.
Whoa, okay, that definitely puts it into perspective.
hmm
But I'm noticing some, let's say, less than stellar figures in the report, particularly in the first half of 2023.
Ah, yes. Their throughput took a dip, about 6% compared to the previous year. The report points to lower storage income and a generally weaker consumer sentiment as the main culprits. Makes sense. Everyone was tightening their belts last year.
Exactly, the global economic slowdown.
Hmm.
Did this trend continue throughout the year, or did they manage to turn things around?
Actually, there's a fascinating twist in the second half. Yantian, one of their key ports, saw a 3% growth in throughput compared to the same period in 2022. They're attributing this to businesses replenishing their stock after that initial slowdown. So, a glimmer of hope amidst the challenges.
Interesting how these big macro trends play out on such a massive scale. Okay, let's switch gears to their retail segment. You flagged A.S. Watson, their health and beauty giant, 159 million loyalty members. That's a mind-boggling number.
It is, isn't it? Speaks volumes about A.S. Watson's global reach, but it's also a goldmine of data. Think about it. This information allows them to understand consumer behavior, predict trends, tailor their offerings. It's incredibly valuable.
No wonder they operate a whopping 16,491 stores across 28 markets, and their revenue seems to reflect this strong performance.
Indeed. We're seeing 8% growth in both reported and local currencies in 2023. Asia and Europe were particularly strong, showing that the brand resonates across diverse demographics.
But wait a minute, I'm seeing some contrasting data here. Their other retail operations, mainly in Hong Kong, are telling a different story.
This is a perfect example of why we need to look beyond the headlines, right? While A.S. Watson thrives, their other retail businesses, like the Park and Shop supermarkets in Hong Kong, saw a 14% drop in comparable store sales. Tough competition, changing consumer habits. It's a very specific battle they're fighting in that market.
So even within a successful segment, there are micro battles being fought. But it seems like A.S. Watson's health and beauty focus is their winning horse.
You could say that. Their H&B segment boasted a 15% jump in EBITDA and an 18% jump in EBIT in local currencies. They're strategically riding the wave of global demand for health and beauty products, particularly strong in Asia, the UK, and their Rossmann partnerships in Poland and Germany.
And they're not just riding the wave, they're expanding, right?
Exactly. For instance, in Western Europe, they added 61 stores, bringing their total to over 5,700 in that region alone. Clearly playing offense, not defense.
This is already painting such a complex picture of CK Hutchison.
Yeah.
I'm starting to see why you wanted to do a deep dive into this. Shall we move on to their infrastructure segment? I have to admit, this is the one I'm least familiar with.
Good choice. This segment primarily revolves around their 75.67% ownership of CK Infrastructure Holdings Limited, or CKI, which is a listed subsidiary. They also have joint ventures with CKI, so it's a layered approach to infrastructure investment.
Okay, so it's not just about owning bridges and power plants. It's more strategic partnerships and long-term plays.
Exactly. And what I find particularly interesting is their focus on sustainability within this segment. It's not just about profits, it's about responsible infrastructure development.
Yeah, I've seen they've highlighted projects like UK Rail's battery-powered trains and HK Electric's offshore terminal. Pretty impressive for a company known for more traditional infrastructure.
They're walking the walk, too. They've achieved a significant reduction in their carbon footprint, about 740,000 tons of CO2 emissions in Scope 1 and 2, hitting 18% of their target.
Putting their money where their mouth is. This is definitely a side of CK Hutchison I wasn't expecting. Now, what about their telecommunications segment? It's no secret that this industry is facing a lot of challenges.
A lot of transitions, for sure. The sale of their tower assets in the UK, for example, cost them around HK $1 billion. That's a big hit.
I'm also seeing increased operating costs. Energy costs alone surged by HK $1.2 billion, and another HK $0.9 billion went towards dealing with inflation.
Yeah, those are the external pressures. Every telecom company is grappling with them. But they're not shying away from investment. They're doubling down on network expansion, especially in the UK, particularly 5G.
Playing the long game. But is it paying off, or are they throwing good money after bad?
It's a bit of a mixed bag, to be honest. In Italy, they're facing headwinds. Wholesale revenue declined by HK $1.4 billion. This impacted their overall performance in the region. But their three-group Europe operations are showing some resilience. 1% revenue growth, 3% margin increase in local currencies.
Okay, so some wins, some losses.
Yeah.
What's driving the success of three-group Europe?
They've managed to grow their customer base and implement some successful revenue-generating initiatives. For example, their average revenue per user, ARPU, in the UK climbed 3% to 12.05. Suggests they're attracting higher-value customers, offering services people are willing to pay for.
That's a good sign. Means their strategy is working in some areas, at least. And how about IOH, their Indonesian operation? How are they navigating that market?
IOH presents another interesting case. They actually saw a decline in their active customer base, but still achieved a 10% revenue increase.
Wait, how is that even possible? Are they just raising prices on their remaining customers?
It's more nuanced than that. They're focusing on improving average customer lifetime value. Think of it as prioritizing long-term profitability over simply chasing subscriber numbers.
Quality over quantity. It seems to be working, considering their post-IFRS 16 EBITDA shot up a whopping 23% year-on-year, reaching IDR 23,938 billion.
It's a strategic shift. Might not be immediately obvious in the raw numbers, but it tells you a lot about their long-term vision.
Okay, we've covered a lot already. We've seen a global port operation wrestling with economic headwinds, a retail giant with both a star performer and a struggling segment, an infrastructure arm embracing sustainability, and a telecom business trying to navigate a rapidly changing landscape. Quite a whirlwind.
And we're just getting started. We've only scratched the surface of CK Hutchison's 2023 story.
I'm ready for more. Let's dive into the financials next. I know you've got all sorts of highlights and key metrics marked up in these reports. I'm particularly interested in how these diverse businesses translate into their overall financial health.
Let's put on our financial analyst hats and see what the numbers reveal. All right, so let's get into those financials. Time to crunch some numbers.
I'm ready. I'm really curious to see how those different business segments we talked about actually affect their bottom line. Where do we even begin with something like this?
Well, let's start with the big picture. Overall profitability. The report shows that profit attributable to ordinary shareholders decreased quite a bit, actually, by 36%, down to HK $23.5 billion.
36%. That's a pretty steep drop. Should we be worried, or is there, more to the story?
There's always more to the story, especially with a company as, well, multifaceted as CK Hutchison. While the decline is significant, you have to consider the context. Remember those external factors we discussed earlier, the global economic slowdown, rising energy costs, inflation.
Right. So it's not just internal struggles. It's also a reflection of that whole global situation.
Exactly. And to really understand what's going on, we need to dig a bit deeper. Their underlying profit, which excludes certain one-off items, also declined, but not as dramatically. Down 9% to HK $23.5 billion.
Okay, so underlying profit paints a slightly less dramatic picture. What were those one-off items that made the reported profit look so different?
One big one was an HK $11 billion impairment of goodwill in their Italian telecommunications business. Basically, they had to adjust the value of that business on their books, because it wasn't performing as well as they initially thought.
So like admitting the Italian telecom arm isn't as valuable as they hoped?
Precisely. These kinds of adjustments, while they do impact the reported profit, are sometimes necessary to give a more accurate picture of a company's, true financial position.
Okay, so external pressures and internal adjustments affecting profitability. What about other key metrics? Revenue, EBITDA, EBIT, all that good stuff.
Right, let's get into those. Starting with revenue. Their total revenue decreased by 15% to HK $2,302 million. And this was largely driven by the factors we've already touched on: the slowdown in global trade affecting the port segment, the struggles in other retail, the challenges in the Italian telecom market.
So like a multifaceted decline reflecting the headwinds they were facing in different parts of the business.
Exactly. Now, EBITDA. That's earnings before interest, taxes, depreciation, and amortization. It's essentially a way to look at their operating profitability, how much cash they're generating from their core operations.
So stripping away some of the financial complexities and just focusing on how the core business is doing, what's their EBITDA telling us?
Their EBITDA declined by 19% to HK $1,184 million. This is broadly in line with the revenue decline, which suggests their operating margins, meaning the percentage of revenue they keep as profit after covering operating expenses, stayed relatively stable.
So even though their revenue shrank, they were still able to maintain a similar level of efficiency when it came to managing those operating expenses. That's a plus, right?
Absolutely. Shows they're adapting. Now let's look at EBIT, earnings before interest and taxes. This is another profitability measure, one that takes into account their depreciation and amortization expenses.
I always get those two mixed up. What do depreciation and amortization actually represent again?
Depreciation. That's the gradual decrease in the value of a tangible asset over its useful life. Think machinery, buildings, that kind of thing. Amortization is similar, but it applies to intangible assets like patents or software.
Okay, so essentially it's accounting for the wear and tear on their assets over time.
Precisely. So their EBIT, factoring in those expenses, decreased by 33% to HK $520 million. Now, this is a more pronounced decline compared to their EBITDA, suggesting that those higher depreciation and amortization expenses played a part.
Makes sense. Considering their investments in infrastructure and technology, constantly upgrading and expanding, you'd expect those depreciation and amortization charges to be higher.
Spot on. These figures really show how those strategic decisions, like those big infrastructure investments, can impact financial performance in, various ways.
So we've seen declines in profitability, but also signs of strategic investment, efficient cost management. Now, I'm really curious about their balance sheet. What's that telling us about their overall financial health?
Think of the balance sheet like a snapshot, capturing their assets, liabilities, and equity at a particular point in time, like a financial health checkup.
All right, let's see how healthy they are. What are the key takeaways?
Well, if we focus on CKI, their infrastructure subsidiary, we see a picture of a pretty solid financial standing, HK $13 billion in cash on hand, and a low net debt to net total capital ratio of 7.7%.
Those sound like good signs. What do those figures actually tell us about their financial strength?
Well, that high cash balance gives them some breathing room, right, to navigate uncertain economic conditions, pursue new investments, or even return value to shareholders. And that low net debt to net total capital ratio, that suggests they're not overly reliant on debt financing, gives them more flexibility.
So they're not drowning in debt and have cash to spare. Reassuring in today's volatile market.
You got it. And their credit rating reinforces this, a stable from Standard & Poor's. That indicates low risk of, defaulting on their debt.
That's good, especially for investors looking for some stability. What about their debt structure? How's their debt spread out?
Total bank and other debts decreased to HK $274.9 billion. They've got a balanced mix of notes and bonds, about 67%, and bank loans, about 33%. This diversification helps manage their interest rate risk and ensures they have access to, different funding sources.
Okay, so healthy balance sheet, manageable debt, good credit rating. Now, on to the cash flow statement. This is where we see the actual money coming in and going out, right?
Right, and here's where that adoption of HKFRS 16 comes in. Their cash flow statement now includes those lease liabilities, giving a more complete view of their cash outflows.
You mentioned HKFRS 16 earlier. Can you remind me what that is and how it impacts their reporting?
Sure. It's a new accounting standard, changed how companies report leases on their financials. Basically requires them to treat most leases like they were finance purchases, so recognizing both an asset and a liability on the balance sheet.
So acknowledging those financial obligations tied to their lease agreements, even if they don't actually own the assets.
Exactly. This impacts their cash flow reporting too. The principal portions of those lease payments are now classified as financing activities, while the interest portions are classified as operating activities.
Okay, so a more nuanced breakdown of their cash flow. What I'm really interested in is their free cash flow. That's the cash they have left over after covering their essential expenses and investments, right?
Right, free cash flow. It's key for assessing their financial health and ability to, well, generate cash that can be used for things like new investments, debt reduction, or, even distributions to shareholders.
So more free cash flow, more options, more wiggle room.
Yeah.
What about CK Hutchison's free cash flow?
The report doesn't explicitly state their free cash flow. We'd need to dig into the statements, grab those data points, calculate it ourselves, but I can walk you through how to do it if you'd like.
Yeah, let's do that. I'm curious what their free cash flow says about their flexibility.
Okay, so we'll begin with their operating cash flow. That's the cash generated from their core business operations. Then we subtract their capital expenditures. Those are the investments they make to maintain or grow the business.
Operating cash flow minus capital expenditures equals free cash flow. Got it. What do those numbers look like?
Let's have a look at the cash flow statement. So I've got that free cash flow number for you.
Okay, let's hear it. What's the verdict?
After doing some calculations, it looks like their free cash flow for 2023 was around HK $15 billion.
HK $15 billion. That's a lot of financial firepower. What are they doing with all that cash?
Well, as we talked about, they're investing in those growth initiatives, especially in telecommunications and infrastructure. They're also keeping their balance sheet strong and, of course, paying those dividends. But there's another way they're returning value to shareholders, share buybacks.
Right, share buybacks. We touched on that earlier. Can you remind me how that works and what it means for investors?
Sure. Throughout 2023, they repurchased and canceled a sizable chunk of their own shares, about HK $4 billion worth.
So they're basically using a portion of their profits to reduce the number of shares out there. Why do that? What's the strategic thinking?
It's a way for companies to signal confidence in their future. By reducing the number of shares, they're increasing the ownership stake of the remaining shareholders.
It's like they're saying, we believe in ourselves and we're putting our money where our mouth is.
Exactly. Plus, it can boost earnings per share, which is a key metric investors look at when evaluating a company's profitability.
Seems like a win-win. Okay, we've covered a lot of ground in this deep dive. CK Hutchison's businesses, their financials, their approach to shareholder value. What's your overall assessment of this company as they move forward?
They're a complex company, that's for sure, but they're navigating this global landscape pretty effectively. They faced challenges in 2023, no doubt. But their strong financials, their strategic investments, their commitment to shareholders, it all paints a picture of a resilient company with a long-term vision.
Not without their hurdles, but ready to tackle them. What should we be watching closely as CK Hutchison moves into the future?
I'd say keep an eye on how they execute those technology transformation initiatives. Their ability to really leverage digital innovation across their various businesses will be crucial for staying competitive, driving efficiency, and, finding those new revenue streams.
And their commitment to sustainability, especially in their infrastructure segment, that's likely to play a bigger and bigger role going forward.
Absolutely. Sustainability isn't just a trend anymore. It's a core part of doing business. Their ability to weave those sustainable practices into their operations, it's going to be essential for mitigating risks, attracting investors who care about ESG, and, even opening up new opportunities.
Well, I think we've given everyone a solid deep dive into CK Hutchison's 2023 journey. Hopefully our listeners feel more informed about how they operate, their financial performance, and where they're headed.
I agree. We've unpacked those complexities, highlighted the key takeaways, and hopefully sparked some more research and thinking on your part.
And that brings us to the end of our deep dive. Remember, this is just the beginning, right? The business world is constantly changing, and CK Hutchison is no exception. Keep learning, stay curious, and form your own conclusions about this fascinating company.
Until next time, happy investing.